This recording is about impairments, and I actually cover impairments of tangible assets, impairments of limited life intangibles, impairments of unlimited life intangibles, and impairments of goodwill. And each of these have a separate process that has to be gone through, so you need to know all of them. Okay, so first one, we've got information about equipment, and we're testing it for impairment. So this is the tangible assets. So our carrying value for this asset is the cost of $9 million minus accumulated depreciation of $1 million, giving us $800,000. When you have tangible assets for impairment, first step is you check to see if the carrying value is less than the expected future cash flows. So our carrying value is $8 million. Expected future cash flows are $7 million. So we fail this step and we have to go to the second step. The second step, we take the fair value of $4.8 million, subtract the carrying value of $8 million, and we determine that there is an impairment of $3.2 million. So the journal entry would be loss on impairment, $3.2 million, accumulated depreciation equipment, $3.2 million. Okay, at the end of 2014, since we wrote the impairment, for 2015 depreciation, we need to calculate it. So our new carrying value is $4.8 million. There's a 4-year life remaining, so that would be $1.2 million a year. So 2015 depreciation is $1.2 million. Accumulated depreciation, $1.2 million. Okay. Now this next example, we're looking at the case where you have equipment, but it's being held for sale because there's a slightly different rule for that case. So again, our carrying value is still $8 million. We still fail step one. The carrying value of $8 million is not less than the expected future cash flows of $7 million. So we have to go through and calculate the impairment. In this example, because we're planning on selling it, we have a cost of disposal we have to take into consideration. So the fair value is $4.8 million. We have to subtract from that the cost of disposal, which is $20,000, and then also subtract the carrying value, which gives us an impairment of $3,220,000. So we'll record that loss on impairment, accumulated depreciation of equipment. Now there's no depreciation because this asset is being held for sale. It's not being used, so we don't have to depreciate it. At the end of 2015, the asset is still not sold. The fair value of the equipment at that point is $5.3 million. So what we see is that we pass the carrying value compared to the expected future cash flows. We don't have them, but usually those are larger than the fair value. And we do see that because the equipment is being held for resale, we can recover some of the prior year impairment. So if our fair value is $5.3 million, we take out the disposal cost of $20 million, and the current carrying value is $4,780,000. There's $500,000 of impairment from 2014 that can be reversed. So we debit accumulated depreciation, credit recovery of impairment loss for $500,000. Okay, this is an example with copyrights. So these are limited life intangibles. So when you have a limited life intangible, you do a two-step calculation again. So we're comparing carrying value to expected cash flow. Our carrying value is $4.3 million. Expected cash flows are $4 million, so we fail that. We go to step two. The future value is $3.2 million. Subtract carrying value of $4.3 million. We have an impairment of $1.1 million. So we debit loss on impairment, and we credit copyright because we're not using a contra account for tracking the amortization. Okay. Next one, we want our amortization expense for 2015. So we take the new carrying value of $3.2 million. There's 10 years remaining useful life, so we're going to depreciate $320,000 a year. So we have amortization expense debited, copyright credited $320,000. At the end of 2015, we're going to compare the we're going to test for impairment. So our carrying value is $2,880,000. Is that less than the expected future cash flows? Well, they didn't give us those, but it is less than the current fair value. So there's no impairment, and you don't get to write assets back up unless they're being held for resale. So no entry. All right, this is goodwill example. So first step, we're going to take the fair value of the division. And if we didn't have the fair value for the division, we would use the estimated future net cash flows. Well, you would use them discounted, and that's treated as equivalent to the fair value. Okay, so compare the fair value of the division to the fair value of the net assets, which they gave us at the $350,000. And we failed that test, so we have to move to step 2. So the fair value of the division is $335,000. Fair value of the net assets, except for goodwill, is $150,000, and I got that by taking the $350,000, subtracting the $200,000 of goodwill. That implies goodwill of $185,000. Our book value of goodwill is $200,000, so we need to impair it by $15,000. So we're going to debit loss on impairment for $15,000, credit goodwill for $15,000. Okay, now we're in the next year. So again, we're going to, at this point, they're saying that the fair value is $345,000. We're going to compare that to the fair value of the net assets. So if we were at $350,000, we impaired $15,000. It now has a value of $335,000. So we do pass step 1. So there's no impairment and no adjustment that needs to be made. This is an example of an indefinite life intangible. Well, we have a definite life and an indefinite life intangible. So the copyright has a limited life, so we'll use a 2-step process for that. The trade name, because that can be indefinitely renewed, is considered to have an unlimited life. Okay, so the copyright, they tell us it has a carrying value of $15,000, 10 years remaining life. The trade name has a value of $8,500, and because it can be renewed indefinitely, it has no life, so there's no amortization associated with that. So for the copyright, we have to amortize for the current year, so amortization expense and copyright, $1,500. Then we check step 1, the carrying value of $13,500 less than the expected future cash flow. Yes, it is. So there's no impairment and you're done. Now when we look at the trademark, there's only one step. So we're going to compare the carrying value of $8,500 to the fair value of $5,000. So we need an impairment. So we're going to have to write the value down to $5,000. So we need a debit loss on impairment $3,500, and trade name needs a credit of $3,500.